Welcome to the Microcap Brief. In an earlier episode, we dissected the reverse stock split, a tool companies use to stay listed, but one that demands a closer look at why it's needed. Often, that why points directly to severe financial distress. Today, we're diving into one of the most critical red flags you can ever encounter in a company's filings, the going concern warning. Think of it this way. When you invest in a company, you make a fundamental assumption that it will still be in business a year from now. This is the bedrock of all financial reporting, and it's called the going concern principle. But what happens when a company's own independent auditor shatters that assumption? A going concern warning is the auditor, after reviewing all the evidence, officially stating that there is substantial doubt about the company's ability to stay afloat and pay its bills over the next 12 months. It is the financial equivalent of a ship's inspector looking at the captain's log and declaring, "I am not confident this ship will survive the coming storm." So what triggers such a stark warning? It all boils down to extreme financial fragility. The auditors have spotted conditions that raise serious questions about survival. The most common triggers include, first, a severe cash burn. The company is spending far more money than it's bringing in, and its bank account is rapidly draining. Second, recurring operating losses. The business model itself is consistently losing money, eroding the company's value with each passing quarter. Third, debt problems. The company has already missed loan payments or has large debts coming due that it clearly lacks the cash to repay. And finally, a failure to secure financing. Management has tried and failed to raise the desperate capital they need to continue operating. Now, why is this particularly critical for us as microcap investors? First, microcaps are inherently more fragile. They have smaller cash cushions and fewer financing options than larger companies. A going concern warning here isn't just a yellow flag, it's a flashing red siren indicating the company is teetering on the brink of failure. Second, it changes the entire investment question. Your focus shifts from, can this company grow, to the much more urgent question, will this company even exist in a year? All other analysis becomes secondary if the company's survival is in doubt. And third, it creates a dangerous trap. A company facing a going concern risk is desperate for cash. This desperation often leads to highly dilutive financing deals, where they sell massive amounts of new shares at rock-bottom prices just to keep the lights on. Even if the company survives, your ownership stake can be severely damaged. Finding a going concern warning requires diligence, but it's always disclosed in two key places. First, in the company's annual 10K report, right at the front, in the independent auditor's report. The auditor will explicitly state if they have issued a going concern opinion. Second, it will be discussed in the notes to the financial statements, where management must disclose the issue and present their plan to fix it. Crucially, a going concern warning is not an automatic death sentence. Management will outline their plan, securing new funding, cutting costs, or selling assets. Your job as the investor is to critically assess the realism of that plan. Is it concrete and achievable, or just vague speculation? Has this management team delivered on their promises in the past? So, what's the key takeaway? For a microcap investor, a going concern warning is arguably the most serious red flag you can find. It signals an existential threat. While it may not be a reason to sell in every single case, it demands your immediate and intense scrutiny. It elevates your job from analyzing growth to assessing the probability of survival. Your homework is simple. Never ignore the auditor's opinion. When analyzing a microcap, especially one showing financial strain, proactively check the latest 10K for any mention of substantial doubt or going concern. Understand the reasons for the warning and ruthlessly evaluate management's proposed solutions. Your capital's survival could depend on it. Thank you for listening to the Microcap Brief. Do your research, understand the risks, and invest wisely.